Risk on it is. Well, let's bring in our guest host for this hour. Peter McGuire is here from XM to give us his take on a very wild week for markets. Peter, welcome.
Good morning,
to Ausbiz.
Gemma. Good morning, David.
Look, sometimes, there's not much to talk about by Friday, but it feels like this week isn't one of those weeks.
Oh, yeah, it's been a big week. It's been, I think what we saw even overnight in trade was just absolutely, big moves to the upside. That momentum was kept forward. See how the day plays out as far as, it's a long day. We're 20 hours till it closes. So there's plenty of news and plenty of activity I think that we're going to see. Just in the short run, we really saw that US dollar come under big pressure, big sell-off. Gold smashed up $50, and that really, I think, took everyone by surprise. Equities are well bid up, and I think it'll be a strong day today in Asia.
Pete, what do you make of the price action? It's been very bullish this week. Now, I thought a contested election was supposed to be bad for markets. Now, it was the worst case scenario, but it seems now the divided Congress, gridlock is bullish all of a sudden. Do you get the impression a little bit that we're moving the goalpost when it comes to actually the narratives as to what's driving the markets at the moment?
Well, I think, David, another thing is what Wall Street's actually after, and it might be after gridlock, so we don't see those tax increases, which in turn create, and certainly maybe not the stimulus of what everyone was anticipating, but those big corporate tax cuts won't get pushed through. So that's been a positive for the market. I think it was oversold last week, and that really is, that momentum since Tuesday has been very, very strong, and probably it'll continue for a day or two.
Well, let's take a break from the markets for a second and drill down on a couple of individual stocks. We're going to talk some of the top stories that the one and only Julia Lee from Berman Invest is watching this week. Julia, welcome to Ausbiz this morning. Certainly an exciting week here, but I know that you have taken a closer look at Amcor.
Yeah, this is an unusual one. The first quarter is seasonally traditionally quite weak for Amcor. It tends to make most of its revenue and profitability in the second half. And so there wasn't a huge expectation for guidance to be revised for Amcor. It had been guiding for earnings per share growth of 5 to 10%, and they've increased that up to 7 to 12%. So great to see Amcor shares out of the gate strong, up by around about 5% on the market. I guess if we have a look at Amcor, its North American packaging company packaging business is really driving the returns. And because of COVID-19, this year's a little bit unusual. So doing a bit more shopping, a bit more plastic packaging, and that's been great news for Amcor. Traditionally, a company like this, you just expect it to grow in line with the economy, but this year's been quite a good one for Amcor.
Julia, the domestic housing market is starting to go and show signs of life, certainly here in Sydney, and I know that also around the country it's even probably hotter conditions. Real estate, REA Group, certainly been beneficial of that. I've seen earnings have gone and started to pick up in the first quarter of the year. What was your takeaway from the result?
Yeah, REA did have a price hike on the cards, but because of the unusual circumstances we're seeing at the moment, they're going to put off that price hike until July 2021. So that's a key thing for investors to watch out for. If we continue to see strength returning to the housing market and increasing listings and then a price jump next year, that bodes well for profitability over the next couple of years. REA, of course, is partially owned by News Corp, and News Corp came out with a pretty good result today as well. In fact, if you strip out the North American marketing, it's done quite well. In fact, Dow Jones had a record quarter in terms of revenue as well as profitability. So no doubt that these two companies should trade pretty well on the market today.
Julia, let's talk quickly about Macquarie Group. Now, they have done what every other bank seems to have done and announced profits down by a third. I think that was the average for the big four as well. And I know 24 hours is a lifetime in finance, but could we also sort of compare it going back to what NAB announced yesterday?
Sure. I think Macquarie is very different from the big four banks, where really business in the big four banks is dominated by their loan books. With Macquarie, they do have their market-facing businesses as well as their annuities business, and in many ways it trades more like a fund manager than a bank. If we have a look at Macquarie, one of the unusual things about its result is also the expense side. With the other banks that have reported so far, we've seen an increase in terms of costs and in terms of expenses, but with Macquarie, we've actually seen expenses down by around about 5%. So that's great to see. And also, if we have a look at the actual result, has come in ahead of expectations. Macquarie had been guiding for a 35% drop. We've seen a 32% drop today, and the dividend also coming in ahead of expectations at $1.35, the market having expected $1.30. Of course, it's the market-facing businesses which are doing it pretty tough at the moment. In fact, M&A income has been dragging on the results. So we haven't seen as much M&A activity, but certainly we have seen a lot of capital raisings, and that's helped to partially offset that. But really, it's the markets-facing business which has really dragged down the large part of this result. In fact, down by 42%. That's compared to the more annuity-style business, which is down by around about 7% year on year. But altogether, a pretty solid result coming through from Macquarie, given that the market was expecting a drop of 35%, and well in the tradition of outperforming at its guidance.
Julie, talking about tough operating environments, Vicinity has had a pretty tough one. Obviously hit as well by what's been going on in Victoria up until recently. No real surprises when it came to the update that things are still pretty tough.
Yeah, look, these first quarter numbers have been dragged down by what's happening in Victoria. In fact, if you strip out the Victoria effect, I think revenue was actually up by 1.1%. So things are improving and will continue to improve given that Victoria is now out of lockdown. I think the bigger question for investors is what's going to happen to asset values as well as rents. Whenever you're looking at, I guess, a landlord, you want asset prices to be rising and you want rents to be rising as well. But unfortunately, because of the softness in the retail space, I think it's going to be pretty tough. I think rents will be coming down, and if rents are coming down, asset prices will probably be coming down as well. So despite the recovery that we're starting to see in Vicinity numbers, unfortunately the medium to long-term outlook for these retail landlords is still looking pretty tough. Vicinity is well diversified. It has those regional, sub-regional neighbourhood shopping centres, but I think the whole retail sector as a whole will probably suffer.
Julia, I know that you're a stock picker, but you also follow the broader index very closely as well. The Australian market had a bit of a tumble last week, like we saw offshore, but rebounded very strongly. I can see today up around about 1% without even the entire market being open at this point. Directionally, now that we have a bit more clarity starting to come through when it comes to the US election, it appears, what's the trajectory for the local market going to be from here, say, until the end of the year?
Well, look, we've seen the best week for the Aussie share market since the Australian sugar hit. That's when the budget was announced on the 6th of October, where the market gained 5.8%. Looks like we're going to be up around about 4% for the week, and that's really on the back of the US elections. Having that split result is a good one for markets. It means that those tax hikes that Biden has been banking on probably won't get through the Senate, and instead it will be steady as she goes. And the market will start focusing on the US sugar hit, or the passing of CARES 2, which is the next stimulus package. So if we see that being passed, that should be a good short-term bounce for the Australian share markets, which of course has already started with the election result looking like it isn't going to be a successfully contested one. So a bit of certainty returning to the markets, which is nice to see, and hopefully the next sugar hit is some stimulus coming out of the US.
Yes, well, the XJO currently trading at 6,200 even, so up 1% for the session. So it looks set to go and test those 7-month highs that we saw not too long ago. Julia Lee from Berman Invest, fantastic to get your views this morning. Enjoy your weekend.
Thanks, Scotty. Thanks, Gemma.
I've got to just mention very quickly as well, talk about bullish price action, Bitcoin. Now, it's not something we discuss readily on the program a lot, but Bitcoin has exploded higher. In US dollar terms, currently trading at around about 15,650 a coin.
It's been a bit of a roll for a couple of weeks now.
Yeah.
But,
Pete, do you dabble in cryptocurrencies at all?
Well, I do, but we used to cover them as far as trading, but we stopped that probably the best part of about 18 months ago. I keep a very close eye on it. And it's incredibly volatile, as you've demonstrated there, 15,000. That US dollar coming off, there's no doubt that Biden and this election has created, I think, a perfect opportunity for the crypto space. Ripple, all of those have been bid up, and it'll be interesting to see if we take that all-time high out. I think it's about 19,000 odd. So it's closing in on it. And maybe it's going to be a Christmas present for the crypto space.
But I'm wondering, is this sort of just a trade like to offset the US dollar weakness, or is it more about the structural usefulness of Bitcoin? For instance, when PayPal picked it up, people
Sure.
were talking about that was the reason behind it, or is it just more of a trading asset?
I think it's both. There's probably a weighting of about 60%, 40%. 60% the trading, Gemma, and the 40% is, an alternative. And as we march forward in this decade, there are so many, I think, new technologies are going to become very much part of who we are and what we are. Payment systems, crypto, you name it, are all going to, I think, evaporate the need for cash. And so, watch this space.
Well, I can tell you, it's parabolic-like move. So we said last spoke, it's up at another $100. So all happening this morning in the crypto space. This is an aggregated figure that comes through from various exchanges, but no, very, very bullish price action, you got to say.
Yeah. Well, it's definitely been a big week for tweets. I don't know if there's somewhere where you can check how many tweets were sent, but I imagine it was very top heavy. So quite impressive that we managed to isolate a top tweet for this morning. With the US election still very much on everyone's minds, this one comes to us from Luke Skywalker himself, actor Mark Hamill, with absolutely no context at all, how it started and how it's going following the US election.
I think it's been that kind of week, hasn't it? It started off, I know everyone was fresh-faced and everyone pretty chipper, but I've got to say, it probably resembles a few of the faces out in our newsroom out there. I think everyone's...
I feel for some reporters over in the US who've been non-stop on cycles.
It has been an incredibly busy week for everyone, but that's pretty much, we're getting towards the finishing line. We'll rest up and then go again next week.
Absolutely. Well, the Federal Reserve, as expected, has kept the official cash rate on hold at near 0%, but has flagged readiness to do more if needed. Well, that sounds familiar. This comes as the economy continues to grapple with record COVID cases, which is crippling the global economy.
Several board officials have expressed concern Congress has failed so far to provide further aid for struggling Americans and businesses, though it wasn't mentioned in the official statement. While the economy has begun to recover, FOMC Chair Jay Powell warned the recovery has been slowing.
As we have emphasized throughout the pandemic, the outlook for the economy is extraordinarily uncertain and will depend in large part on the success of efforts to keep the virus in check. The recent rise in new COVID-19 cases, both here in the United States and abroad, is particularly concerning.
The US Central Bank sets to make key changes to how it shares information about outlooks for interest rates and the economy, releasing more details immediately after its policy setting meeting beginning in December.
Well, it's been a big week, economic and markets front as well. So let's get the lowdown from Andrew Tysus from the Mirror live via Skype. Andrew, welcome back to Ausbiz. It has been one of those momentous weeks I think everyone was expecting leading into it. I might go and kick off before the election with what happened on Tuesday with the RBA. No real surprise it seemed from the bank when it came to its policy settings, including the quantitative easing. But the communication levels certainly have appeared to have improved based on what they were in the past. What was your takeaway from that?
Yeah, good morning both. Look, I think we're clearly living in uncertain times, and the package of easing measures which the RBA delivered is historic and quite unusual. So I think the governor was very, very keen to get out on the front foot and explain some of the motivations and the thinking. He held a press conference at 4 p.m. after the 2:30 announcement and took questions. And I thought that was a great move, a great initiative. We'd certainly welcome more of that. Transparency and clarity is always welcome in markets. A range of easing measures from the RBA, designed to do a number of things: lower borrowing costs, provide funding for banks to lend, support markets and asset prices, keep a lid on the Aussie dollar. So really the RBA has pulled out all the stops and is doing as much as it possibly can to support the economy and to help drive the unemployment rate down.
Andrew, for a long time the Reserve Bank has maintained that it will not go into negative territory, but it sounded as though this week that resolution was somewhat weakening. Was that your take as well?
Yeah, look, exactly right. I guess for central banks, we can never say never. The governor has been pretty clear on this. He's said it's extraordinarily unlikely that he would take the cash rate into negative territory, in contrast to a couple of other, maybe half a dozen central banks around the world. However, he opened the door just a smidge in his Q&A on Tuesday afternoon. Someone asked him about this, and he repeated the standard line, extraordinarily unlikely. But he said if the Fed or other significant central banks were to move into negative territory, then they might have to think about that a little bit. Still a pretty strong central case from us that we're not going to get there. But, again, we're living in clearly unusual times, and it's probably safest to never say never.
Andrew, you keep a very close eye on the fixed income world, particularly the bond markets. Now, we saw a big reaction in the Aussie curve to the RBA's announcement on Tuesday, but realistically, since then, it's all been the US election and what's been going on, the toing and froing between the potential candidates as to who would actually go and lead the US. What do you make of the moves that we've seen this week in the sovereign curve, say in the United States and Australia? Are we really looking at a scenario now where we're not going to get a big fiscal package and the same kind of issuance that was being mooted in the past?
Look, I think so. And I think what we're seeing is really position unwinding, which is something which often moves markets. So we saw in the weeks leading up to the US election, US equity market was down 5 or 6%, US bond yields rose. This was on the prospect or the market's thinking that we were likely to see a blue wave, which in turn would lead to a massive fiscal expansion, meaning more bonds and higher yields, and also the possibility of increased regulation of tech, which was seen as a clear negative for equity markets. Now, clearly, it's not entirely decided, of course, but it is looking most likely that we're going to get a Democrat president and a Republican Senate. So the Republicans holding onto the Senate. With that, US fiscal expansion will be less than otherwise. So the bond market is rallying back in relief, and we're seeing US bond yields decline. Australian bonds have been moving in sympathy with that. So it's position unwinding all around the shifting expectations and the surprise that we've had with the US election results.
Andrew, what do you expect to set the tone for the rest of the year? Obviously heading into the last 2 months, if it is indeed a Biden presidency, not much can be done before inauguration, of course. So what would you be watching to check the tone of the markets and the direction from here?
Yeah, well, I think the RBA is largely on the sidelines now. So we will watch the so-called lame duck period. If Mr. Trump does not get across the line, and that would seem to be the central case, one could imagine that he might be an unhappy loser. So the lame duck period could be full of some angst. And Mr. Trump, of course, is still in the chair till the 20th of January. So US policy and US uncertainty could remain elevated for a couple of months. That is something that could weigh on market sentiment. I guess apart from that, we'll just be watching the COVID trends. The trends, of course, in a bunch of countries in Europe and in the US are not good. So that's something we're watching to the downside. And then, of course, this left field sort of tail risk of vaccine progress coming through. But I think those global themes are going to be the biggest ones for the Australian market, rather than anything that's happening locally.
Andrew, just a quick, I think, point of where that US dollar has traded over the last matter of week has been very, very solidly smashed down. And do you think that Aussie has got the potential to take out those August, September highs, mid-73s, and leading into Christmas? What are your thoughts?
Yep. Look, it's certainly looking that way. $8 is a really tricky one. It is just such a pure risk proxy. If you whack it into a spreadsheet and look at some correlations, it's about 90% plus correlated with risk on measures like equities, commodity prices, the price of copper, that sort of thing. The US dollar is looking very soft, so that's another bullish point for the Aussie. So we've had some position unwinding helping the Aussie. We've got a very weak US dollar. It's also the case, I think, that a Biden presidency is expected to lead to more normal relations with China and maybe slightly fewer tensions, certainly around tariffs. China and Asia more broadly is expected to be the winner from that. And anything, of course, which is good for China and Asia is good for Australia. So there's a bit of a tailwind for the Aussie here as well. Our bias on the Aussie is certainly that it will be moving higher over the next 12 months. It's kicked off and started to move a bit faster than we thought, but it's moving in the direction that we thought.
Sure, thanks for that.
Well, here's hoping that those tailwinds from the regional performance go and help us out in the months ahead. Andrew Tysus from Nomura, fantastic to get your views. Enjoy your weekend.
Thank you, you too.
And just a small programming note for you this afternoon on the Pulse, Westpac's senior currency strategist Sean Callow will be walking us through all of the fallout from the ruckus stateside. That's Westpac's Sean Callow at around 3:15 p.m. Eastern, right here on Ausbiz.
Pete, what's your takeaway when it comes to the dollar index at the moment? We've got big twin deficits coming through. We've got no fiscal package for the time being.
Absolutely.
Pretty terrible health outcomes for the time
maybe
being.
no tax cuts.
Yeah, so where does that leave the US dollar moving forward?
I wouldn't be surprised to take that 91 handle out, maybe by January. Further softness, we're at 92.5. It's been solidly sold off. Just for the viewers, we're at 94 and a bit this time last week, or close, Friday/Monday. So I think that
and for the viewers again, where were we in March pre-pandemic, or the height of the pandemic?
Well, at the height of the pandemic, we're at 103.
Okay.
So just really put some flowers around that one. 103 to 92 is such a huge move for that US dollar. That's why we've seen all of those different markets really ratchet very strongly up. So I think there's further softness, and maybe we see an 89 handle sometime in the next 6 months? Quite possible.
Want to go keep an eye on. Obviously, the implications of the US dollar and what it does is so crucial when it comes to the global markets. So you want to keep an eye on. But before we say goodbye to our Twitter audience out here's a quick check on the early movers this morning on the local equity market. And so Tabcorp enjoying some pretty solid gains there, up close to 10%. Resolute Mining also up in that vicinity of the downside. CSR and Adventures, the laggards so far during the session.
Yes, and so unfortunately time to say goodbye to you. Time to change over to our app or the website. If you want to stay watching us, please do. And of course, don't forget to follow us on our social media channels, Instagram, Twitter, LinkedIn and Facebook. All the latest interview highlights plus the odd look behind the scenes at our Barangaroo studios and what we're all getting up to back here. On all our platforms, we are at Ausbiz TV.
Well, the rest of the White House remains in limbo as Democratic nominee Joe Biden remains hopeful he'll clinch the 46th presidency. No additional states were caught overnight, but confidence is growing in Nevada for a blue hold. The AP projection suggests a win in Nevada will put Biden at exactly 270, the number required to go and take the presidency.
Meanwhile, the race in Georgia looks to be heading for a recount. The latest figures show Trump holding a slim 13,000 vote lead, with just a few polls left to report in the Atlanta suburbs. Earlier, Biden delivered upbeat remarks from his campaign headquarters, saying he has no doubt about being declared the winner.
We have no doubt that when the count is finished, Senator Harris and I will be declared the winners. So I ask everyone to stay calm, all the people to stay calm. The process is working. The count is being completed, and we'll know very soon.
Meanwhile, the Trump campaign is continuing its run of lawsuits, this time filing a suit in Nevada, seeking to block what it describes as illegal votes. The campaign has already filed similar suits in Michigan, Pennsylvania and Georgia. Legal experts have already cast doubt over Trump's grounds for a successful case.
We're turning back to equities, and let's get a sense of where our next guest has been buying and selling given this close result in the US election. Todd Hoare joins us now from Crestone live via Skype in Sydney. Todd, welcome to Ausbiz. Just paused for a moment.
Doesn't look like we can go now. We don't have Todd on the line at the moment, but we'll try and get that fixed. But yeah, it's a really interesting question, isn't it, at the moment? I know where the investment opportunities are at the moment. We saw in the stock market, at least, a reversion straight to that old familiar trade of buy tech, buy healthcare. Is that pretty much what your takeaway was?
Well, you've got to look at that and just think, well, if that's where the market's got the momentum at the moment, I don't believe it's exhausted. There's far more. I mean, if you look at healthcare globally, it's such a huge component of the economy. And tech, wow, what we think is cheap today. My son's 25 and he believes that, his whole cohort of, as far as, investors at that age are very much tech savvy, buying into stocks and believe in the long term. So, yeah, I think there's a lot further to run.
Probably the familiarity angle as well.
Absolutely,
if you're going to the market for the first time and you recognise the name Google, Amazon is pretty attractive to get in there.
Tesla, you name it. They're across it. Lemonade, they're just, avid stock pickers, and I think that momentum is just going to stay with us.
Well, our Whiz Tech team has managed to get Todd back on the line. Todd Hoare from Crestone. Think you're with us? Maybe I was just teasing you.
Looks
No,
like,
apologies.
the Gremlins
It's
are
not
back.
one.
It's a Friday, so just have a quick check and see how the markets are faring now. We're now nearly 30 minutes into the day's trading session. And you can see there that I know Chi-X 200 currently up about 0.9%, the same amount for the XJO. Looking across my market map, there's two really dominant themes that I can see is financials and materials absolutely having stonking days. Energy is also having a fairly decent run. That's despite a bit of a mixed pullback in crude futures after what's been a fairly decent run higher. Obviously, gridlocked Congress means that to a certain degree, the chance of that push into the renewables that was hoped under the blue wave scenario may not come to fruition.
Afterpay, one of the darlings, is one of the very few stocks in the red today. Let's have a look at some of the stocks which had news out today. Amcor lifting earnings guidance following a strong start to the year, largely driven by solid performance of its new acquisition of Bemis.
The company reported adjusted earnings before interest and tax of 9% to US $358 million, with a dividend of 11.75 US cents per share.
REA Group, meantime, reporting first quarter profit higher, largely driven by cost cuts. This despite revenue dipping by 3%. And West African Resources getting in early with a $25 million debt repayment. Taurus Funds Management, as the cashed up miner focuses on trimming its remaining $175 million facility to Taurus, and we can see that share up nearly 7%.
VanEck, proud sponsor of the Open, is one of the world's leading ETF providers, giving you unparalleled access to intelligent investment ideas. Find out more at vaneck.com.au.
Pete, I've got to ask you about your 25-year-old son. Was he investing before coronavirus came along? Because my understanding is a lot of younger investors who hadn't had much experience started out for the first time or got more heavily involved while they were sitting at home, unable to work.
Yeah, he graduated from uni, realised that, how do you get into the housing market, or where do you want to, as far as investment? There's no money to be earned as far as bonds. So what are the opportunities? They saw the sell-off. He reappreciated the big story headlines and what's going on globally. So that appetite was embraced, and there's a degree of time off and COVID, but there's also that belief system that they're in for their frontier is 30 to 40 years. My frontier is maybe 15 to 20, so it's a little bit shorter. So in turn, I think the youth of today, and we've seen that with the retail investor, that take up across commodities, currencies, stocks, as the appetite has been absolutely enormous globally. So yeah, I think that they're very well positioned, and many people that weren't traders are now embracing.
Well, let's go and try for third time lucky. Hopefully, we've got Todd Hall from Crestone. Have we got you, Todd?
You have, I think.
Fantastic. We can hear you loud and clear. So let's go and get your views on what's been happening this week. It's been a tremendous week when it comes to volatility and the like. What's your general takeaway of what we're seeing?
It seems to be one of those situations where it was a heads I win, tails I win situation. So you saw on Monday and Tuesday the S&P 500 was up. I think it was something in the order of about 3% on expectations for a Biden presidency, on expectations for a Democratic blue sweep. And then when that didn't occur and we got, I guess for want of a better word, the status quo with a Republican-controlled Senate and maybe a Biden presidency, the market was up 4%. And I think Hamish Douglas has been in the press calling it nirvana. So it seems to be a situation where it didn't matter. But what I would highlight is that it's one of those strange situations where, and I think your previous guest might have been alluding to it as well, was that the headline moves in the indices might just give us a bit of a false read on what is actually happening, because there seems to be tremendous rotation going on beneath the surface. So your interest rate sensitive stocks have come off, your infrastructure proxies have come off, and then obviously your tech stocks, which are 25% of the market in terms of the big five, and if you add healthcare to the mix, you've got 55% of the market. You started to see a huge rotation into some of those names, which were, I guess, a little bit concerned about a Biden blue sweep.
Todd, tell us, when you talk about the rotation, what was the best way to play this? I understand sectorally what you just went through and thematically, but in terms of any particular shares that really put themselves front and centre as candidates to be moved around this week?
Yeah, I think if you take a look at where the largest risk exposures were, they were probably centred around the likes of Google, Facebook, to a lesser degree Amazon, and really what that revolved around was the potential for a Democratic blue sweep to launch their own antitrust investigations. And in fact, we had seen a 449-page report tabled early October calling for the breakup of some of these companies, or certainly the inability to acquire companies in their verticals. And I think that's where the largest amount of apprehension was for the markets. And since it's come to pass that we probably won't get that, and we know that the Republican senators will not support a breakup of big tech, you've seen the likes of Google and Facebook do particularly well on the back of earnings results that, broadly speaking, were already quite positive.
Todd, another area of contention is the energy space. Obviously, two very different views when it came to the candidates. It looks like we're going to have a split Congress. What are the implications for the energy sector at the moment from that?
Yeah, I think you clearly had a pro-renewables bias from Biden and the Democrats in terms of an enormous amount of renewable and significant increase in capacity of renewables, electric vehicle buses, etc. And also potentially some ban on fracking and oil and gas on native US land. I think the fact that we probably get a continuation of the status quo probably means that the downside risk for energy is potentially a little bit less. But at the end of the day, I think the real focus for energy is probably less on the regulatory side and more the fact that OPEC has significant spare capacity. We have COVID-19 demand issues that are clearly weighing on economic growth, and what that means for oil demand globally and for the oil majors, more so than potentially what a Biden presidency and a Democratic blue sweep might have meant.
So when you're adding all of that into the mix, Todd, you've got to say that we're looking at that demand destruction, big numbers, as you mentioned, COVID in Europe and certainly the UK and America. It's really one-way traffic for the crude market. Are you looking at a 35 handle for WTI? Do you think there's further softness across Brent leading into this Christmas period?
It wouldn't surprise me at all. I think you didn't really see a huge pickup in demand during the Northern Hemisphere summer. I think last numbers I checked, you've got circa 7 odd million barrels a day of spare capacity at OPEC, and you've got some of these oil majors trading at 10 to 11% dividend yields, Exxon being the one I'm talking about, sure, which would suggest that equity markets are quite nervous about the direction of crude oil. And I think more importantly, what equity markets are effectively telling us about oil is that they do not want these super majors to be going out there and looking to bring on significant growth projects, because the world simply can't cope with the supply side that we've already got. So unless we get significant fiscal stimulus, which seems a bit unlikely at this point in time, or unless we get a vaccine which can, I guess, put a backstop under global growth, then you'd have to suggest that there's probably some downside risk for oil, I would have thought.
Yeah, I think you're pretty right.
Well, Todd, we're delighted that we managed to get you in the end on the line. Certainly worth the wait. Todd Hall from Crestone, thank you so much for your time and thoughts.
Thank you.
Well, overnight tech and Bitcoin were among the big outperformers, while the rollercoaster ride that is oil continues. We're just discussing with a 1.5% slide in New York. To discuss it all, Chris Weston joins us now from Pepperstone Live via Scutt. Chris, welcome back to Ausbiz. Excluding the movement in crude, is it realistically at the moment all one trade, risk on, risk off when it comes to markets?
Yeah, seems so. I mean, we saw equities moving higher and the dollar just came off pretty sharply on the back of that. So, when the dollar goes down, you got gold going up and silver moving up on a slightly higher beta play. I mean, I think people, the last guest talked about the perfect storm and all these various factors, and we saw rotation, and that rotation seems to be taking on a daily basis. So, last night materials, working tech was still up there, and we didn't even really see a move in bond yields at all last night. So, I think that the tech trade loves the fact that when the discounting mechanism for those cash flows is lower and you're trying to work out a present value, then obviously on the day of the election itself, bond yields were absolutely taken to the cleaners, and we've seen a fairly flatter picture overnight, but certainly the tech trade still likes that. And I think the idea as well as that you've got stability in bond yields is also really positive for markets as well. So you take away the big fiscal stimulus, you've got stability in bond yields. Tech loves that, and we've just got a risk-on environment. Whether that continues for a foreseeable future, or whether this is just a couple of days positioning move, is obviously yet to be seen. But I don't think people are really too concerned about the president. That really doesn't matter too much. This was more about the congressional split and the fact that we were going to basically see the Dems in the House and the Republicans in the Senate, and you're basically going to see the Fed do all the hard work going forward.
Yeah, speaking of that, so very little movement last night from the Fed. Was it just waiting to see the election result and not trying to steal the limelight from politics? And do you think actually there'll be more going on next month?
I think there will be more in the next month. I mean, the COVID situation still has some legs. As your last guest there said, that we're still in very much the hope phase of the vaccine, and the market is really pinning on their belief that we're going to hear something reasonably soon that sort of moves this along. But I don't think anyone was expecting this was always going to be a non-event. I mean, if you look at financial conditions, they're incredibly accommodative at the moment, whether you're looking at credit spreads, whether you're looking on high yield or investment grade, whether you're looking at equity markets. The dollar's on a weakening trend. Volatility is high, but it's come off a little bit in the last couple of days in terms of implied vols. And if you look at inflation expectations through the Fed's 5-year forward gauge or anything like this, they have been moving a little bit higher. So there was really no reason for them to act at this meeting. But I think when we go into the December meeting, what the Fed need to do, now that we know that there's going to be this congressional split, and then fiscal is going to probably be at the most next year somewhere between $500 billion and $1 trillion. They're not going to get that fiscal support for incomes. The Fed need to win credibility if it's to get its average inflation target believed by the market. Now that means, we don't know how that's going to happen at the moment. We know the mechanism, but their objectives, but we don't actually know how they're going to go about creating average inflation targeting above that 2% level for a sustained period of time, other than base effects, which will kick in from around sort of April time. So I think that December meeting is about credibility for me. They need to win show the market how exactly they're going to do that and raise inflation expectations. And the way they do that for me is that they have to bring real yields markedly lower. They need to get 5 and 10 year or 5-year real inflation adjusted yields down towards 2%. That would cause the US dollar to weaken. We'd see global trade volumes picking up. You'd like to see the dollar CNH or the offshore yuan weaken. That would obviously put purchasing power into the Chinese importers' hands, and that would have a big effect on global inflation expectations as well. So I think the Fed, what they need to do in that December meeting is show everyone how they're going to do it. And I think part of the reason that the cure for that is much lower real yields, which will have a significant effect on the US dollar. And I think that would go some way to achieving inflation in the US, but obviously it's no panacea there. But certainly I think that December is about winning credibility.
So I've got to go and ask you about the outlook for it. It's been absolutely hosed this week, taken out to the woodshed, as you would go and describe it in some other instances. Where's the path of least resistance when it comes to the big dollar?
It's part of sort of the longer term macro framework. I don't have a chart to show you right now, but if we use the dollar index, and dollar index is obviously a poor one for the dollar because 57% of that weighting is down to the euro, and who on earth wants to really buy the euro of any major conviction at the moment when you've got the restrictions playing through there and lockdowns, and obviously the disinflationary trends leading to deflation, in fact. So it's a difficult one, but I think if you go to the sort of longer term time frame on the monthly of the dollar index, we're still trending higher in this sort of bullish channel, and we're still waiting for it to break down. But fundamentally, it feels like to me that, as I say, if the Fed are genuinely going to achieve longer term inflation to meet its objectives, its three-pronged objectives, it needs a weaker dollar, and most countries as well need a weaker dollar. That you're going to get strength in the emerging markets, which is going to have this feedback loop back into the US. So fundamentally, it feels to me that if the Fed really, really want to do what they need to do, then they need a weaker dollar. It's going to be part and parcel, and that's going to be really driven by lower real yields, inflation-adjusted Treasury yields. So whether you're looking at them in isolation in Treasuries or whether you're looking at them on a relative basis, we need lower real yields. The Fed have the objective now that the onus is on them to achieve that. How they go about doing that, we don't know. But it feels to me instinctively, if the Fed are going to do that, they need a lower dollar. And every other central bank out there is a price taker. The Fed is the price maker of the market, and they control everything. Everyone else's job, the RBA, the ECB, the Bank of Japan, their job is to make their currency less attractive. That's all they can do. They have to lower the appeal to buy that currency. That's all they can do. The rest of it's down to what happens with the Fed. And as we've seen overnight in the Aussie dollar hasn't moved up because of the RBA has failed, as some people have suggested. If you look at the Aussie dollar, it's just moved almost tick for tick with S&P futures. So that's completely out of the Reserve Bank's hands. The Aussie dollar is just a vehicle for trading risk sentiment. There's not much the RBA can do. They can limit the appeal of buying the Aussie dollar, but when it's a vehicle for trading a thematic, it's really down to the hands of the Federal Reserve and global risk sentiment.
Maybe some quantitative easing of the S&P 500 futures, perhaps, in a different light. Chris Weston with Pepperstone, fantastic to get your views. Enjoy your weekend.
Cheers, guys. Take care.
Well, we're lucky enough to be joined by a steady flood of guests this morning, so we're going to turn to our next guest to get his views from what's going on in the markets, from the equity bull market in the US to the volatile week for 10-year yields, and why he is backing gold in a time of great uncertainty and volatility. Grant Patterson joins us now. He is MD at Providence Wealth and is here live with us in Barangaroo. And of course, still with us is Peter McGuire from XM. Spoiled for choice with guests.
Thanks, Gemma.
Welcome to the show, Grant.
Thanks, Gemma.
Volatile week for bond yields, but also looking back a bit further, month or so as well. What's your take on the activity we've seen there?
Well, I mean, I think volatility is here for some considerable time, and it's now going to be the norm. So there's obviously been an enormous amount of news going around at the moment, and there's very conflicting views are out there. It's very uncertain. I think this is probably one of the most challenging and complex markets that I've been involved with over the last 20 years, because you're getting mixed messages. And so the old rules don't seem to apply anymore. There's new monetary theory that's coming out. So you've got this week, for example, the equity market very, very strong, pointing to strong growth, recovery in the economy. Yet the bond market, the US bond market, is telling you the reverse. The bond yields have come down, which would be normally an indicator that they're concerned about disinflation and lack of growth. So that's where all the volatility is around at the moment, and the jury's still out.
Grant, I might go and stick on that bond yield theme story. Nominal yields have been volatile. Some of the biggest moves in percentage terms we're seeing daily this week in a long, long time. You said that it reflects potentially that there's a diminishing growth prospects moving forward. How much is it positioning as well? Because we know that a lot of people were backing the Biden blue wave, that obviously doesn't look like it's going to come to fruition now.
Yeah, I think there was a bit of pre-poll positioning, and it now looks like the Senate stays with the Republicans. So the market's taken a bit of a breather from that. I mean, we've got to remember that the bond market really is being manipulated by the central banks around the globe. So it's very hard to see whether the same rules still apply, Peter. I mean, it's different this time around. The result will probably be the same, but there's different dynamics at this stage.
Absolutely, the ingredients and your comments as far as where they go is from a bond side, but more importantly, I think that gold story has been very much a part of that fear entering the market over the last couple of days, and what we saw overnight was just astounding. So that momentum leading up to Christmas could be a very nice time for both miners and, more importantly, for investors.
Yes, yeah. I think the gold in our portfolio is predominantly a protection and preservation of capital,
sure,
particularly in Australian dollar terms. So that's really why it's in there, and that's where, rather than actually seeing where the gold price is about to go in the short term, I don't know. Yeah. But it's certainly, I think, warranted in portfolios to protect and preserve capital.
Absolutely. Now, Chris Weston was making a really interesting point earlier, saying that which is quite obvious when you stop and think about it, but the Fed is a price maker, everyone else is a price taker. Has that always been the case? Has the RBA always been this impotent and this dependent on what happens?
I think globally it has, but it's a different environment to what it was in the 90s, where our interest rates were at 17%. If you put your mind back to that, so the last 10 or 15 years have changed the course as far as we've had global financial crises, we've had COVID, we've had a race to the bottom as far as interest rates, negative interest rates, inflation at the floor. We're playing very much a part of that whole big game, and where we move from here, who knows? We might be at negative territory come February or March. we haven't got far to go.
No, and I think, it's an interesting point with where we are with the Reserve Bank and the central banks. I mean, they used to be independent of government. They're now interdependent on each other. So that's a big change. And really the size of the financial market has become so huge that it's actually dictating to the central banks what they have to do, because it's become such a big part of global economies.
Exactly.
What's the outlook for inflation here globally? Now, we know that a lot of changes have been made at the central banking level this year. We're talking about average inflation targeting in the United States. We've got the RBA's now switched to a mechanism where it's not going to consider going and hiking interest rates until we start seeing the actual rate in the band, its target. Is this wishful thinking that we're actually going to see this come to fruition, or are we still going to look at the same what we've seen over the past couple of decades, where it's just a continual trend lower?
Well, if you put your mind to energy prices, and they're a big indicator, we've seen softness there and nowhere back to $45 or $50 a barrel. We're now in that high 30s, and further softness possibly over the next 3 to 6 months. COVID numbers out of control, so that doesn't stay in your mind to say, well, right, that's a big push up for inflation. That's a deflationary. And I think there's so much nervousness. We've got this week as far as the election. Is Trump in or out? There's a lot of unknowns, and we've got a stock market out of control, very, very strongly bid up. If you saw what happened in Asia yesterday, and certainly across Europe, it was just one-way traffic. Some of those markets were astounding. Russia was up 6.5%.
Yeah, I think, look, the inflation sort of story is starting to get a little bit of airplay, but it's still some way off. I agree with Peter. I mean, the M2 money supply figure has exploded, the growth there, but there's just no velocity of money at the moment. So it is something that's on the radar screen for investment committees at the moment, but I think it's more, and in our view, it's more an 18-month, 2-year, 3-year type concern. I mean, the central banks are going to do all they can do to get the debt up, and certainly the inflation rate up, and governments certainly want it up to try and pay off their debt. So I think it's a bit early yet, but it will be on the agenda over the next few years.
Yeah.
We're being told in our ear that US President Donald Trump is currently speaking. So Grant Patterson from Providence Wealth, thank you so much for joining us on the program this morning.
Thanks, David.
Right now, we're going to take you live to Washington. You can see the President is speaking right now.
Points in Florida, and they were off by 8.4 points, and I won Florida easily. So they had me losing Florida by a lot, and I ended up winning Florida by a lot. Other than that, they were very accurate. They had him up 4 points in Ohio, and they were up by 12.2 points. And I also won Ohio, great state of Ohio, very easily. The Washington Post said Biden up 17 points in Wisconsin, and it was basically even. They were off by about 17 points. And they knew that. They're not stupid people. They knew that. Suppression. There are now only a few states yet to be decided in the presidential race. The voting apparatus of those states are run in all cases by Democrats. We were winning in all the key locations by a lot, actually. And then our numbers started miraculously getting whittled away in secret. And they wouldn't allow legally permissible observers. We went to court in a couple of instances, and we were able to get the observers put in. And when the observers got there, they wanted them 60, 70 feet away, 80 feet, 100 feet away, or outside the building to observe people inside the building. And we won a case, a big case, and we have others happening. There are lots of litigation, even beyond our litigation. There's tremendous amount of litigation generally because of how unfair this process was. And I predicted that. I've been talking about mail-in voting for a long time. It's really destroyed our system. It's a corrupt system, and it makes people corrupt even if they aren't by nature, but they become corrupt. It's too easy. They want to find out how many votes they need, and then they seem to be able to find them. They wait, and then they find them. And you see that on election night. We were ahead in vote in North Carolina by a lot, tremendous number of votes. And we're still ahead by a lot, but not as many, because they're finding ballots all of a sudden. Oh, we have some mail-in ballots. It's amazing how those mail-in ballots are so one-sided, too. I know that it's supposed to be to the advantage of the Democrats, but in all cases, they're so one-sided. We were up by nearly 700,000 votes in Pennsylvania. I won Pennsylvania by a lot, and that gets whittled down to, I think they said now we're up by 90,000 votes, and they'll keep coming and coming and coming. They find them all over, and they don't want us to have any observers, although we won a court case. The judge said you have to have observers. Likewise in Georgia, and they're appealing. Actually, they're appealing. We won a case that we want people to watch, and we want observers, and they're actually appealing, which is sort of interesting. I wonder why they'd appeal, that all we want to do is have people watch as they do the vote tabulations. Likewise in Georgia, I won by a lot, with a lead of over getting close to 300,000 votes on election night in Georgia. And by the way, got whittled down, and now it's getting to be to a point where I'll go from winning by a lot to perhaps being even down a little bit. In Georgia, a pipe burst in a faraway location, totally unrelated to the location of what was happening, and they stopped counting for 4 hours, and a lot of things happened. The election apparatus in Georgia is run by Democrats. We also had margins of 300,000 in Michigan. We're way up in Michigan, won the state. And in Wisconsin, we did likewise fantastically well. And that got whittled down. In every case, they got whittled down. Today, we're on track to win Arizona. We only need to carry, I guess, 55% of the remaining vote, 55% margins, and that's a margin that we've significantly exceeded. So we'll see what happens with that, but we're on track to do okay in Arizona. Our goal is to defend the integrity of the election. We'll not allow the corruption to steal such an important election, or any election for that matter. And we can't allow anybody to silence our voters and manufacture results. I've been doing a lot of public things for a long time. I've never had anything that's been as inspirational, by people calling, talking, sending things to us. I've never seen such love and such affection and such spirit as I've seen for this. People know what's happening, and they see what's happening, and it's before their eyes. And there are many instances which will be reported very shortly. There's tremendous litigation going on, and this.
That is US President Donald Trump talking live at the White House in Washington. That footage comes courtesy of Facebook.
Well, let's talk credit and the impact the US election is having on the space. And for investors in the space, voter turnout has been absolutely crucial, but more so a sense of how each man would handle the coronavirus pandemic beyond the stimulus fight in Congress. Our next guest says that it is that fight which is causing big volatility on the bond markets. To discuss, John Sorrell joins us now. He is Nikko Asset Management's head of credit and is sitting here at the desk with us in Barangaroo. John, welcome to Ausbiz. Gee, there was so much interesting stuff in that intro, but actually I might just take you back to the speech we just heard to link it in. If I was a lawyer, I would be rubbing my hands together with glee right now, because it really sounds as though Trump is prepping for a fight on many legal fronts at this point. You spent a long time looking at the election before it happened, researching it. How much does the outcome we've seen so far tie in with what you were anticipating?
Yeah, I worked through 6 scenarios that, ranging from very positive to very negative. And this came probably as the worst scenario, where there's not a very clear conclusion, although you might note that actually Biden got 50.5% of the vote and only 48.7% to Trump. So it is really an electoral college battle. And so in this scenario, it's just going to be problematic, and there will be litigation. There will be an ongoing arguments about the problems of whether these votes were valid or not. And so it is going to be drawn out, and it's going to mean that the handover process, assuming Biden does win, will be marred by a lot of noise, which doesn't help the situation, particularly in addressing the real issues, which, as I think you mentioned, are pandemic and the economy, so the stimulus package and issues like that, which build confidence.
John, when it comes to credit, you're concerned about solvency and you're concerned about cash flows, being able to go and pay off the debt that's owed. Given the election at the moment and the way it stands, where does it rank in importance? It doesn't seem like it's actually up there. I've noticed, you're talking about the pandemic and things like that. That seems to be a much more stronger influence on credit markets.
I would agree with that, yes. I think it's very much the secondary order. It is an issue because the question becomes how will they manage and how will they at least slow the spread of a pandemic? And that probably from an Australian credit perspective, maybe not so much a US credit perspective, but from an Australian credit perspective is probably the biggest question. So I would say, yes, it is an issue, but it's probably an indirect issue for us.
Talk to us about the trajectory of the credit markets this year, because so many things have been thrown at the markets. What shape were they in coming into the pandemic? How have they coped throughout it? And now we've got the election, of course, so contested election.
Credit markets were very strong up to the pandemic, and spreads were coming in, so there was sort of a bid tone to the whole credit market. Then in March, there was panic and spreads moved out, the market moved out, and it was a market which was actually weak, very weak. And since then, people realised that it's not the end of the world and that has come back. Plus, there has been very strong sovereign support, not so much in Australia, although in Australia, but particularly overseas, with credit being very much in demand and competed with government buying of it. So this has meant that credit markets have actually performed and have come back. If you were to look at Australian banks, they've come back lower than they were before the pandemic opened. But across the market, there's a very strong spread contraction.
John, how important is the role of central banks? So we heard from the FOMC this morning, giving hints that there potentially could be some more quantitative easing on the way as soon as December. Of course, this week here in Australia, the RBA launched outright quantitative easing as well. When it comes to the corporate credit market, how important is that central bank backstop?
At the moment, I think it's very critical. It gives confidence at a time when there is a lot of skittishness and nervousness. So it is actually a market where the central bank, in standing there and being seen as a buyer, is actually just assisting and maintaining spreads. I mean, maybe as a credit investor looking for wide spreads, it's probably a negative, but for most it is actually a positive.
John, I know one of the areas you looked particularly closely at was how other countries would react to the election outcome, but also how it unfolded. How should other countries be thinking about how this all went down?
Well, it does weaken the sort of belief in the democratic process of the US, and it does encourage countries like China and Russia to actually be more aggressive. They can see that there is a good possibility that US will be stepping off the global stage and being much more inwardly looking. That was already happening, but I think it's just increased that.
John Sorrell, Nikko Asset Management Head of Credit, thank you so much for joining us in the studio this morning. Enjoy your weekend.
Right, thank you.
Thank you.
And staying in the credit space, Allied Credit secured a $200 million backing this week. The company has backed some of the biggest names in automotive and recreational finance. And to discuss the deal and what it means to the company, John Moody joins us now from Allied Credit, live via Skype. John, welcome to Ausbiz. Congratulations on this deal. Talk us through some of the mechanics of what it's about and what kind of yield did you get it off at and what kind of tenor are we talking about?
Yeah, thank you, David. Yeah, it's a great outcome for us. We're very happy to have got it away during this time. It's about $200 million. There's the AAA notes were about 75% of the whole deal. And the weighted average spread came in tighter than we'd hoped, actually, which was great, just over 2%. So we're very happy.
The plans for this financing round?
Sorry?
Oh, in terms of the funds, what are the plans for the funds?
Oh, right, yes. Well, we're using the funds to free up some of our warehouses that we had, that we'd emptied out into the term out so we can continue the growth. We'll do these term transactions, I think, every year, at least from now on, as we fill our warehouses up and then term them out. It's great that we've been able to use leisure assets, marine assets and motorcycles to do this for the first time in Australia as well. It bodes well for our funding in the future. So we're very happy that we've been able to, I guess, take this next step in Allied Credit's development to become a larger company, which is our plan.
John, you'd be an excellent person to go and ask about the outlook when it comes to consumer discretionary spending. There's a lot of uncertainty because of what's going on with the economic conditions with the mix of stimulus that's in the pipe at the moment. What is the sense that you're getting, what you're seeing through the numbers there?
Well, interestingly, the motor vehicle market has had 31 months of year-on-year declines, although it's just starting to stabilise now. October was only a couple of % off last year. Motorcycles, on the other hand, are up 26% year-on-year, which is quite a stunning difference between the two markets. And I guess motorcycles are a more efficient way of travelling. People who are not wanting to take public transport, it's a cheaper mode of transport. And also they can be toys, and people are spending their money on toys as opposed to travel at the moment. But we are starting to see that motor vehicle, the auto market is turning around, particularly with the stimulus that the government's provided for business users.
John, tell us about your plans for the year ahead. You mentioned this was a momentous deal for Allied to get done, closing it just before the end of 2020. Does this change the plans, the strategy, the trajectory for the company in the year ahead?
Look, the growth plans that we had prior to going into COVID still exist. We've been delayed a little bit, of course, as everybody has, but the opportunities that are out there for a company like ours, we have this unique joint venture model that no one else in the market offers. We've got a lot of interest in that from people that are looking to secure their finance when it comes to having more control over how their customers finance their assets. So there's a growth path ahead of us which we intend to follow.
John Moody from Allied Credit, Chief Executive Officer, thank you for your time this morning.
Thank you.
And now some last words from our guest host, Peter McGuire from XM. That hour went really quickly, not helped by the President's interruption, but...
He's got a story to tell.
He does indeed.
Yeah, and he's not out of the game yet, but yes, he's certainly concerned about what goes on over the next matter of days.
So Pete, what's your base case scenario now? We've got a sense of likely makeup of what we're going to see with the presidency and Congress. How do you play that as a trader?
Certainly the first thing I look at every morning is US dollar. What happens? Where does it move? And that softness, the VIX, strip that out of the market as far as the heat. So that's really telling me that it's an onward push. I want to ask myself a couple of questions from an equity standpoint. Are we at year time highs right now? Does our market move stronger into Christmas? Does the US market move stronger into Christmas? I'm unsure. I think the fear side of it is really creating a little bit of turmoil, and that's where that gold push was demonstrated last night. Crude, I think, is going to be softer. Mm-hmm. It's a hard one to really evaluate from a trading perspective if you're looking at a longer term. But for a short term, I think those opportunities are very much part and parcel of who we are and what we are. So there's some good opportunities out there.
Let me just pick up on crude. Not a very positive near-term outlook for many people. Longer term, does it pick up again before the whole renewable trade really takes off?
Well, you know, I don't know, Gemma, whether those days of 55, 65 are over and we never visit there again. And a couple of reasons why. First off, demand destruction. COVID is out of control and we haven't got anywhere near a vaccine to say we're going to quarantine this. So I don't think we're going to see huge growth. There's oversupply as far as crude. And from an inflation standpoint, I think we're going to see softer, not higher values. So that's going to be good for the spending power of mums and dads globally. I think the good days may be behind us, but I think the trading opportunities are very much part and parcel. It's a great time to be a trader of it because the movements we've seen this week have been outstanding.
The volatility has certainly been right up there with weeks gone by in the GFC and the European debt crisis and other periods as well, so that's undoubted. Peter McGuire from XM, fantastic to have you over the last hour. Enjoy your weekend.
Thank you very much, guys. Cheers.